everyone has to know what the Fed is doing. The Fed has become ubiquitous, handsy as some politicians we know. It has become like the referee in a football game. So when you get to know the name of the umpire or the referee, you know that umpire or referee is not doing his or her job right. If that person is supposed to be invisible. The game is a thing, right? And not the rules.
Hi, everyone. I'm utterly delighted to be here with today's guest, Jim Grant. Jim, it's lovely to see you. Thank you so much for joining us.
Well, it is lovely to be here, William.
Thank you. I wanted to start by asking you about your early years. You had a somewhat unusual early life. As I understand it, you came from a very musical family, and it looked like you were poised to become a French horn star and
yes.
were going off to college in Ithaca. And then something changed rather dramatically. Can you talk about those early years, if possible?
Yes, my father was a Juilliard-trained timpanist. He played the kettle drums in the Pittsburgh Symphony, among other places. And then World War II came along, and he came back from it. And he and my mother presented the world with my brother and me. And my father at length turned to business to make a living. And I, for my part, became enchanted with the horn. Dennis Brain was the great reigning virtuoso. He was a Brit. And I resolved to become Dennis Brain. And also the first baseman for the Brooklyn Dodgers, and a dairy farmer, and a naval officer. And succeeded at actually none of those things. The highest rating I attained in the Navy was gunner's mate, third class. But I devoted many hours a day to practicing, well, 2 or 3, and was quite serious. And for the French horn players listening, William, I attempted.
There are so many of them, Jim. That's one of our biggest demographics, I think.
I attempted the Strauss second concerto, not the first, mind you, but the second, and rather butchered it. And but I was not quite good enough, I think, to have been a really top flight professional. And it was either for that reason or others that I joined the Navy when I was the day after I was 17. It was the Naval Reserve. I was still in high school. This committed me to 2 years active duty and 4 years reserve duty. And I wanted something, evidently, at the age of 17 that had nothing to do with the horn or even with women. And that something was, I guess, adventure and patriotism. And I admired my father's World War II. So he was a naval officer and served aboard attack transports. Oh, once my father was censoring the enlisted man's mail. They were at the Battle of Leyte Gulf. And he reads the following: Dear mother, if you knew where I was, you... Podlasky, is that any way to write your mother? Well, sir, she would. All right, so I wanted some of that life as well, and it did indeed live it for a time. So I went to college for 1 whole semester before I chose to go on active duty. This was in 1965, and served for a couple of years as gunner's mate aboard the USS Hornet, which was an aircraft carrier.
And this is during the Vietnam War, right? So right, you were, correct. Am I right in thinking that you were off the coast of Vietnam?
For a time, yeah. Yep, yes, we were.
I mean, I know you wrote to me yesterday sort of saying something along the lines of, my personal story lacks the heroic element. But as I was saying to you, when I was 19 or 18, I was at boarding school kind of throwing darts at a friend of mine and, pouring milk on this carpet that was said to be waterproof to see if I could make a swimming pool. So I wasn't doing anything very heroic at all. So I wanted to get a sense of what you were
well, we were our ship was an anti-submarine carrier. We specialized in helicopters and in fixed-wing aircraft that would pursue and sink Soviet subs. So the enemy was not actually the Soviet Union, although at one remove it certainly was. But the Vietnamese Navy, happily for us, was then undeveloped. So we mostly steamed off the coast. The air crews were certainly in great danger. We were not. So we would refuel our destroyer escorts. We would hand off ammunition to them. They would go and bombard the coast. But it was mostly quite routine, as I say. I never got shot at, nor did we fire a shot. Once we encountered a Soviet freighter off the coast of Haiphong, and we gave him the middle finger. So that was a kind of an offensive gesture. We saw Vietnamese fishing boats, which had the biggest radios. Nice people, but big radios. Yeah, it was definitely a war, but as I said, we were, I guess I was to the Vietnam War as the residents of Scarsdale were to the New York City urban crisis, near it, but not in it.
And three of your comrades, if I remember right,
yes,
mates, went back for something like 4 years on swift boats to get shot at, and you didn't, right? You decided
I did not.
You had enough.
I wanted to go to college, but gunner's mates Von Essen and Wicks and Simpson, three wonderful characters, re-enlisted for 4 years for the privilege of serving on swift boats and indeed getting shot at and shooting. And full of admiration for them. Yeah, so I lost touch with them over the years, as one does, and I attempted to get back in touch with them on the occasion of an exhibit that the New York Historical Society was putting on about the Vietnam War. And wouldn't you know it, two of the I couldn't come up with Wicks's forwarding address, but two of the three friends I had just died prior to this thing. It's kind of sad. One of them, Dale E. Simpson, gunner's mate, third class, was in fact a storybook character. He was forever getting into trouble, but in the way you want a fighting man to get into trouble. He was absent without leave. He was overstayed liberty in the Philippines, and I came aboard late and was deathly hungover and watched with the saddest countenance as the ship pulled away from the pier, and he watched his unclaimed laundry recede into the distance. Anyway, so they went to Vietnam, and I did not.
And I remember you saying he spent something like 2 weeks in the equivalent of solitary confinement.
Oh, he was, yeah. One time he really, as they say, missed movement, which was used to be a capital offense in wartime. But no longer. So what happened? So he was flown aboard the ship, which is kind of a cool thing. He landed in a plane aboard the carrier and got a kind of not a hero's welcome by everyone, kind of a villain's welcome from the authorities. And was given what was called captain's mast, which is a form of judicial inquiry, and sentenced to like 2 or 3 weeks or a month in the brig. And he was the best and toughest prisoner the Marines ever had. So he was our John McCain.
That's great.
He was our John McCain. Yeah.
So Jim, how did that period of early service in your life actually either shape you in terms of your values and your character, or just reflect your values and character, which seem to have been adopted to some degree from your father, who you obviously
I think both. It's certainly. So I got out after 2 years. And I worked a little between discharge and my return to college. But when I did return to college, the privilege of study, the unimagined principle of the unimagined gift of study and solitude, even on an aircraft carrier, you can never be alone, really. So the privileges and the gifts of return to college, I think it allowed me to have the kind of college experience that middle-aged people could have if they could do it all over again. I returned a couple of years older than my classmates at Indiana University, and I could see that they didn't cherish what they were doing the same way I did.
Yeah, I think I blew my college experience because I was young for my year anyway, because I was born in August, and I was done with Oxford by the time I was 20, which was just about the time when I was mature enough to start appreciating that I was there.
You must have had like an Edward Gibbon experience, right? Unsupervised and
yeah, and I'd been at boarding school where you had total supervision and no freedom at all. And then suddenly I was and brilliant teaching. And then suddenly I was at Oxford and had the freedom to wake up at 11. And so I think I went to something like one lecture in 3 years, although I did read an enormous amount. So it was, I mean, I really read a tremendous amount. So it was good in that sense. But that's interesting. So you had this kind of intensity and seriousness by the time you were studying economics at Indiana University. And then I think you studied international relations at Columbia, but somewhere along the line there, if I'm right in thinking, you got a summer job on Wall Street, didn't you? And I'm curious to know.
Oh yes,
early experience taught you.
Very formative thing. I got a job on Wall Street, and I got out of the Navy in early February, and I got a job soon thereafter at a firm called McDonnell and Company on Wall Street. And I earned, instead of $75 a month, I earned $75 a week. It's fabulous. And however, I was by far the lowliest employee in this room of what we call institutional salesmen, people who were stockbrokers for banks and insurance companies. They all earned $100,000 a year, which was not such a small sum today, but a quite magnificent one in 1967. So I could almost smell the money. I decided I liked it, and I liked the markets. And so I by that time I had resolved to return to college. I went to Indiana, which was a mecca of kind of a state conservatory. It was a very good school, especially for horn players. Oh, as I drove back from the West Coast to the East Coast upon my discharge from the Navy in Long Beach, California, I stopped by Indiana and I announced to one of the virtuosi, I said, I have been accepted as a horn player. And he said, oh, really? I never have been. And that was such a deflating little, and I think that's what put me off music. Anyway, I came back and chose economics on the strength of my 6 or 7 or 8 months, whatever it was, at McDonnell and Company.
And do you think there was some sense in which you saw either from your summer job or your 6 to 8 months on Wall Street and from your experience studying at Indiana University that there was a big difference between your image of what was actually going on in the trenches on Wall Street and the reality, which presumably was pretty unsalubrious at the time and not that intellectually rigorous? What did you discover? What did you see that kind of informed your skepticism and cynicism about Wall Street that marks a lot of your journalism?
Well, the skepticism and cynicism about Wall Street was I attained that gradually and by degree. I was quite open-eyed in Indiana, and what I mostly imbibed in my economic study at Indiana was the history of economic thought, which then was a very serious subspecialty in economics. It's no longer taught. Everything happened 15 minutes ago, as far as the economists today are concerned, which is in part how I make my living, is by recalling episodes that people have put out of mind. There's a professor named Scott Gordon who taught a history of economic thought, which I just loved. And there are others as well who introduced me to some of these ideas.
So did you come out of that experience with abiding principles from, say, the Austrian economists?
Not then. That came rather later. But I came out with a fairly good grounding in the principal thinkers of economic theory. And the course was, now that I look back on it, was rather heavy on Keynesianism and monetarism. Milton Friedman was one of the demigods. Certainly Keynes was in the forefront. And I've come to see the clay feet of both economists and both set of acolytes. The convictions that I have since adopted concerning free markets and the so-called Austrian approach, we can talk about what that actually is. That came a little bit later.
So then you got a job. I think your first real job in journalism was at the Baltimore Sun on the financial desk.
Yes.
And then went
to the first it was covering police and fires and writing obituaries. That was the.
But then you got demoted to cover the financial world,
right? Well, it was by far the least prestigious post in the paper. There was a certain amount of kind of fake daring do about covering crime. Although, there's, you've heard, I'm sure your listeners heard about a show called The Wire. Famous.
Yeah. I was at high school with Don West, who played McNulty. He was a close friend of mine back in those days. Yeah.
Well, anyway, I was a reporter who supposedly knew something about crime. I had no idea any of this was going on. I must have seemed to the criminals of the city of Baltimore the most pure, innocent.
Were you walking along the mean streets wearing your bow tie, Jim, back in those days?
I was thinking, what a peaceful city. So I watched this series with your friend with a sense of, as every fan watched with an immense admiration for the series, but also in my case with a certain amount of humiliation that all of it was such a surprise. I should not have been quite so surprised as a police reporter. So anyway, an opening came up in the finance department. And I was the Warren Buffett of the newsroom, having spent 8 full months at one stretch, and not to mention summer vacations working on Wall Street.
And then you went to Barron's, right? From something like 75 to 83, and you originated the current yield column.
Yeah.
And I wanted to ask you about that period, because it must have been an incredibly formative period, because those of us who, I was born in 1968, so I wasn't really aware of what was going on at the time. But this great inflation that ran from 1965 to 1981 was forming the backdrop of your career in those days as a financial writer. And I wondered if you could describe for us, for those of us who didn't experience it firsthand, what you saw and how it shaped your views about the importance of sound money, fiscal discipline, and the like. Because it must have been kind of a rude awakening to see. I think didn't inflation hit something like 15% in 1980? I mean, it was a terrifying time.
Yes, although it became rather one became rather acclimated to it. I think never wholly adapted to it. But my goodness, the inflation rate had been tripping up since 1965. And the authorities then, as today, said, first of all, not us. Nope, we didn't do it. And then this will pass. And then, and actually before very many years had gone by, William McChesney Martin, who was then the Fed chairman, and a great rhetorical foe of inflation, would give these speeches condemning it and vowing to slay it like a beast. But towards the end of 1967, in close confines of the meeting of the Federal Open Market Committee, said, the horse of inflation is out of the barn. So he was about ready to give up. I said, most we can do is to make sure this steed does not gallop away too far, too fast. So then ensued year upon year of deteriorating purchasing power of the dollar, of rising interest rates, of contracting what we call valuations for stocks, meaning the price you pay in relation to what the company can earn. It's a valuation. And we express this as a ratio of stock price to profits. We call it a price earnings ratio. And during the good times, the stock prices go up, and people are willing to pay a higher and higher price for a given dollar of profit. And when inflation hits and when interest rates go up, the opposite happens, and people pull back and they're willing to pay less and less per dollar of profit. And that was the story of this great inflation. There were, of course, ebbs and peaks and undulations. And one of the things that happened then that I think is very great relevance today is people were all too ready to declare an end to things when inflation receded. Now, nothing says that today is going to repeat the experience of yesteryear. In fact, rather the odds are against that, just simply because history is never so helpful as to repeat itself literally. Otherwise, imagine how rich the historians would be. So they say, and what they say is true, that one's first experience in markets and with money is deeply formative and imprints itself on you. And the best investors, the nimblest and most successful are ones who can put that formative experience aside, or at least put it in the perspective and not imagine that they must repeat the experiences of their youth and their middle years. Perhaps that experience was too deeply imprinted on me, or I allowed it to be too deeply imprinted. But I have, I guess, have seen inflation under rather too many bedposts and under too many mattresses over the years that have gone by.
But you were right in the end. And
yes.
So we'll come back to that at great length later.
Let us not forget to come back to that.
we will return. This will be the heart of our conversation. You then left Barron's. I think there was some sort of squabble at the top.
Oh, it was. The smaller the financial stakes, the more intense the domestic politics. You can see it in college English departments. And my mentor at Barron's was a wonderful guy named Robert M. Bleiberg. Robert M. Bleiberg was an infantryman during World War II, served and was wounded at Okinawa, served in the Philippines in Okinawa. And people who had experience are forever pissed off at some level, And Robert M. Bleiberg combined Patrician's modulated speaking voice with a wonderful, rich vocabulary of obscenities. And he would storm into the office and say, in this mildness, he would say, tell them, meaning the corporate chieftains, to get us the things we need. Penny-wise, pound-foolish bastards. So he get away with cliches and away with obscenity. And it was wonderful to listen to him. He enunciated. He was like a stage actor. He was a dyed-in-the-wool free markets guy who had no use for the state, no use for the Fed, was properly and deeply cynical about the undertakings of the central banking world. And I certainly absorbed much of that from him. I also, as the fellow who wears bow ties and he doesn't have to, I went to the public library in the weekends and I read bound volumes of The Economist featuring the works of Walter Bagehot, the famed Victorian author of Lombard Street, book we can talk about if you decide that's relevant, and also wonderful leading articles, as you would say, in The Economist. And I would actually count his words to get a sense of his. I could tell his style. His style was marvelous. He invariably had the money market comment in The Economist, and he wrote under, of course, the regime of the gold standard. He wrote in the 1860s, 1870s, and it wasn't exactly through him entirely, nor through Bleiberg entirely, nor through my readings entirely. I think this must have been a character, trait or flaw or whatever. I have a lifelong abiding fascination with gold and the gold standard. I admire its simplicity, its elegance, its efficacy. And so all all these ideas and these what do we call them today, influencers, combined to lead me in the somewhat eccentric financial direction I have taken. I say somewhat eccentric, I should say very eccentric.
Before we dispatch with Bagehot, who I'm likely to forget if we don't talk about him right now briefly, Bagehot, you ended up writing a biography of, which I have on my back table here, but I'm embarrassed to say I haven't read yet because
there's all the time in the world, William.
There is. I was reading your Bernard Baruch book, which we'll talk about later, which is a wonderful book. But if there's one enduring lesson from Bagehot that stuck with you from studying this guy who you regard as the greatest Victorian, is there something that's of relevance to our audience that we can get the 30-word version of Bagehot's life from you?
It is that interest rates, a topic that does not enchant everyone, are critically important, and that when you suppress them or otherwise manipulate them, you generate adverse consequences. They call it today reaching for yield, some of hygienic phrase. It doesn't do it justice. What it means is scrounging around in the worst of the leftover remains of the investment markets for things that will return you something on your capital, and taking inordinate risk to do so. So Bagehot taught this lesson. He said, John Bull, alluding to the national symbol of Britain, John Bull can stand anything, said Bagehot. He can't stand 2%, meaning that if you impose an interest rate as low as 2%, my goodness, it seemed at times in recent years rather lofty. But if you impose as little as 2%, people will send their money abroad. They'll send it to Argentina and they'll lose it. They'll send it to, they'll send it to Cuba, and use it. So they'll take risk. So that's one abiding lesson.
So that's hugely relevant as well.
Yes,
later,
yes,
for the last 12 years, this experiment since the 2009 crisis.
One gets a sense, and not just in reading Badgett, but in reading financial history, that yes, human beings change. Certainly, technology changes, but the interaction of people with money is enduring and rather stable. People talk about the efficient market hypothesis. I think people are just as efficient around large sums of money as they are around attractive people of the relevant sex.
So you will come back to some of these lessons from the past that inform this current period. You then quit Barron's, and as I understand it, you went and founded what I would call Grant's Interest Rate Observer, but I'm aware that it has to be
Grant.
I'm so sorry, and I mispronounced your name as well at the start. So Grant's. So you quit, I think, with something like $75,000 from your profit sharing plan at Dow Jones,
right?
And you had 2 kids on the way, and started this business in 1983 with something like 35 people subscribing to your first issue. What were you thinking?
I was thinking bankruptcy. Patricia, my wife, and I were first movers in the automated spreadsheet called Lotus 123. My technophilia ended about 1983, the year it began. And we were capable of generating the most plausibly bullish projections by putting in what turned out to be the most impossible assumptions. We assumed, I don't know, my readership at Barron's was let's call it 150,000. So I figured if only half of them subscribed, half subscribed, then we would have major tax problems before the year. Yeah. So we did not have we had no tax problems, but we did have a revenue problem. And the revenue problem persists. I don't think I took a salary until like 1987 or something, 1988. So the world had enough to read, as it turned out. Even then, had enough to read. And Patricia, in addition to, we had 4 kids by the time I took a salary. But she was working at the Lehman Brothers, which so long ago was that the Lehman Brothers was still solvent. Yeah, and it paid her a good salary as an investment banker. So she supported all of us as Grants came into its own, or began to come into its own.
And then once it came into its own, she became a neurologist, right? Which is an extraordinary.
She did. She went to medical school. We had it was only 4. It seemed like 40 kids, but she did it, and she graduated from the Albert Einstein School of Medicine at the age of 49 plus.
Wow.
The second oldest in her class, she would have us know, not the oldest.
I was very excited to have dinner with you and Patricia, your wife, a couple of months ago.
And delightful.
Yes. I was happy to meet you, and then I left thinking, God, she's formidable.
I should have the wrong person on the podcast.
Yeah, where I interview Patricia, she's a remarkable person. So, but so one of the things that struck me is the name of your publication, and you once wrote, "It wasn't false modesty that led me to choose the word observer for the banner of my 12-page journal, rather than say soothsayer or prophet. The truth is that I can't forecast interest rates, and neither can many other people, yet the temptation to forecast is ever present." And so can you talk a bit about that idea of setting up a publication, Grant's Interest Rate Observer, that would observe rather than predict? Because this strikes me as kind of one of the essential quandaries that we're all facing as investors, that we have to position ourselves for the future, and yet the future is somehow, as you often put it, unfathomable.
Well, it's a closed book, isn't it? And one can pretend. And at intervals over the course of the almost 39 years now, I've been doing this with considerable help, by the way. But over the course of these nearly 39 years, I have sometimes given in to bouts of delusion. So strong can one's conviction become about a certain stock or bond or market that one yields to an unbecoming and certainly mostly unprofitable dogmatism. But just as you say, William, markets are about the future, and if you can't know the future, you must contribute something to the difficult but necessary job of imagining it, right? You can't dogmatize about it. you can conceive a view of it based upon the alignment of forces of the present, about the way people themselves are expecting the future to unfold. If everyone thinks one thought, you have an edge because you can investigate the alternative. As often as not, the idea that's most popular is least remunerative. Not always, but often. So it's like you can walk into a doctor's office and the doctor will say, well, no, the test does not look very good. And so that's disturbing. Well, what do we do about that? He said, well, we really can't tell very much. We can kind of handicap the odds a little bit. Thanks. But that's kind of Wall Street too, right? We can't know the future, but we can handicap the odds based upon some knowledge of the past. Again, not a dogmatic rendering or overlay of the past on the future. I use this word dogmatize a lot because I hear people, especially the ones who are not 75 and a half, say things as if they knew them when, I see myself in a lot of this. And I hear people say, here's the way it's going to happen. And sometimes they're right, which only makes it worse. But again, you can't cop out and say, well, we'll know more next year.
Yeah, I thought it was striking. I was looking at some of your greatest hits over the years, and obviously you made some really big prescient calls that helped to make you and Grants an important force in the world. I mean, I think I'm right in saying you were incredibly prescient in predicting the implosion of the whole junk bond bonanza fueled by Michael Milken and Drexel. You were incredibly prescient before the global financial crisis in sort of seeing what was wrong with the housing market, and actually got praised in the movie The Big Short as the guy.
That sweet? Yeah,
that was kind of lovely.
Yeah.
And likewise, incredibly prescient in being an early critic of companies like Valiant and WeWork that blew up after lots of very smart people thought that they were wonderful. And yet, on the other hand, I can also see there are these things where, you've been criticized for telling people to sell stocks in the 90s during the bull market, way before the tech bubble burst, or you were warning about the bond bull market ending in 2016, way before it ended. And I wonder if you could just talk about the moral of that. I mean, is the moral the general futility of market timing? Is it important? Because it seems like you were directionally correct with all of these things, but actually timing them in a way that makes it actionable is excruciatingly difficult.
All of that is true. And I don't want to say that, I don't want to speak for others by asserting that no one can do that. There are people who have made a fabulous living on Wall Street by not getting everything correct, by having such a tactile sense about the ebbs and flows of cycles and about the interior of the market's mind, to kind of reading the psychology of the marketplace. And great traders, Paul Tudor Jones, Stan Druckenmiller, to name only two, have this capacity. And so there are those who do that. And I think, but what I have discovered about myself, and it's not a recent discovery, but I've come to understand the depth of how I operate. And I think I do my best with disaster. I'm a critic, and I'm not a child of 1929. My father was. My father watched his father go broke. His father had no business doing anything in the stock market. His father was a high school educated autodidact who became the dean of music at Penn State College, as it was then known. And but he went on margin in I'm sure he got exactly the top on margin in 1929 and lost everything. My father had nothing to do with stocks. Everything reminded him of 1929. Now, I didn't imbibe that directly, but I have, I think, inherited a sense of deep appreciation of the downside. Not so much fear of it, but I kind of relish the idea of catching on to it, of seeing it, and then warning others. It's a sweet line of work if you can do it right. And it was sweet to have been validated in 2007 and 8 and 9 with the help certainly of people like Dan Gertner, who kind of decoded the horrifically complex mortgage derivatives that we were able to explain to people. But we asserted in 1996 or something that the stocks were overvalued. My God, they had not begun, to paraphrase the Federal Reserve today, they had not begun to think about becoming overvalued in 1996. The elapsed time between having declared stocks overvalued in 1996 and the top in 2000, that was about 50 years of psychological time in coming to terms with all that. So I've one is confronted with the old medical school gag that Patricia related to me, that everything you learn here, no, of all the things you learn here, half is going to be wrong. What we don't know is which half, right? Everything you think about markets, no, half of what you think is going to be wrong. We don't know which half, et cetera, et cetera. So I want to confess to this tendency, this trait, this weakness, but I also don't want to convey that we have given up trying to do something about helping people understand the unfathomable future. That's what we do for a living, sometimes more successfully than others.
I spent part of the last few days reading back issues from the last year or so of Grant's Interest Rate Observer, and it's still so painful for me to say this. And
you could relapse into the native tongue.
Grant's Interest Rate Observer.
That sounds much better.
And I was thinking, God, I wish I had read this earlier. That it would have made me. Like you, I'm sort of a pessimistic journalist who always assumes that everything's going to go to hell. So I didn't take crazy risk, but I think it would have sharpened. Reading your analyses would have really sharpened my sense that something historic has been going on in the last 12 years since the financial crisis. Yeah. That's this kind of wild experiment that nobody knew or could know what it would lead to, and that the conditions were increasingly fragile. And I wondered if you could talk about that, because now the thing that you were warning about for years has come to pass, and we're suddenly seeing this surge in inflation, and all the fragility you were warning about has become exposed and revealed. Can you put in context for ignorant laymen like myself, what was actually going on during those dozen or so years since the global financial crisis in terms of this kind of reckless monetary experiment that you were warning would lead inevitably to this kind of crisis that we're now seeing?
Yes, inevitably is not so very helpful a train of thought introduced into an investment periodical. I think Keynes said something to the effect that if you say something is going to happen in our lifetime, say, thanks. But we don't like Keynes. All right, so two things have happened. One, you can quantify, and the other is rather inchoate, but still, for that, still important. The quantifiable thing is that in the wake of the Great Recession, the central banks of the world, led by the American Federal Reserve, decided to stimulate. Yes, they use that verb, stimulate business activity through suppressing interest rates, thereby tending to raise up the prices of stocks, bonds, and real estate. And Ben Bernanke himself, in a Washington Post op-ed, I think 2010, announced this was the intention of the Federal Reserve's low interest rate policy. He was going to buy bonds with the expectation others would follow suit. People would pay more for a dollar of those corporate earnings. Stock prices would rise, and the rate that profits were capitalized would rise. And people would come into capital gains. They'd feel richer and be richer and thereby spend more. So we used to call this trickle down, but now it took a rather fancier name. This was the portfolio balanced channel theory of investment. For Christ's sake, what are you saying? You're saying we're going to lead us by the nose into the stock market, which they did. So that happened in a quantifiable way. So the inchoate part had to do with the mind of the market and the expectations of the market, and what came to be absorbed, what people came to believe, is the Fed would be there for them. That the Fed wanted things to go up, that the Fed would make us rich, and that if if perchance, if by accident, if through some cyclical hiccup, the market pulled back, the Fed would make it go back up again. Okay, so this takes us to say, let's take us 2020. We'll fast forward 2020. And comes the pandemic, comes the falling off of the cliff in March. And what does the Fed do? The Fed, never mind the kitchen sink, the furnace, the plumbing, the furniture, everything in that house got tossed at the problem. So to go into the active voice and the passive voice, the Fed took charge of making sure that this pandemic did not lead to a depression. And what followed this was one of the most astonishing light shows in the history of central banking. By the time 2021 came to a close, the broadly defined money supply was showing growth year over year in excess of 20%, never before seen in such a short period. Interest rates collapsed. The speculative fervor that all of this created was lifting stocks, bonds, real, everything, cryptos, NFTs, everything that wasn't nailed down. Nothing was nailed down. It's a massive levitation of everything bubble, some of us called it. And what also occurred was an undesired inflation on Main Street itself, at the cash register, at the checkout counter. So the Fed never minded inflation at the corner of Broad and Wall Streets, New York Stock Exchange. That was desirable because that made people spend and encouraged investment outlays and the like. But the Fed is in business to prevent and ameliorate, if it does occur, inflation at Main Street, right? And that wrecks wages, that wrecks budgets, that distorts the values, that gets elected officials defeated at the polls. That's that kind of inflation they don't like. But we got that too. So now here we are with inflation rampant. It's not an exaggeration. Stock prices still elevated by historical lights. Bond interest rates, bond yields are still very low by historical reckoning. So what does the Fed do? Well, it's rather in a quandary. And that's where we stand today.
So I remember you warning on your Grant's Current Yield podcast, which is terrific, which I really encourage people to listen.
Well, that's high praise.
No, it's really good. I'll include a link to it in the show notes here. You said at one point the Federal Reserve is the most dangerous financial institution on the face of the earth. So you were saying how they're always meddling and having to improve and intervene and interject. Before we get to the current problem, is there just this illusion that it's helpful to intervene and interject? Like, where's the philosophical difference that you have and that someone like Jerome Powell, the Fed chief, has in terms of believing that it's worth meddling or actually dangerous to meddle?
Yeah. Well, I think that the Fed believes, I know the Fed believes because they do this stuff. The Fed believes that they can select a rate of interest, a policy rate of interest, that will at once encourage maximum employment, minimize the rate of inflation, and keep the financial markets percolating. And I say, many of us say, that rate is known not to God, but to individuals operating in a free and untrammeled market and discovering, that word is price discovery, the phrase is price discovery, discovering a rate of interest. And what makes the discovered rate of interest better than the artificial or the imposed one is that the discovered rate of interest is the product of decisions taken by people who have no idea what their counterparties are doing, but they're all trying to maximize their own welfare in the world. They all go to work in the morning wanting to do better. They make decisions. So the conflation of these myriad decisions is going to give us a better outcome than the somewhat arbitrary and necessarily ill-informed pronouncements of the former college economics professors who populate the halls of the Federal Reserve. We call this at Grants, we call the current standard, we call it PhD standard, as distinct from the gold standard or other standards of yesteryear. And, ages ago, in 1930s, I guess, not so ages ago, but a while ago, it was economist named, I think, Henry Simons, University of Chicago, who said that business enterprise ought not to be a speculation on the future of monetary policy. And that's kind of what it's become. Everyone has to know what the Fed is doing. The Fed has become ubiquitous, of course, as handsy as some politicians we know. It has become like the referee in a football game or a soccer game or cricket or baseball. I'm trying to help with you.
A proper game, cricket.
So when you get to know the name of the umpire or the referee, you know that umpire or referee is not doing a job, not doing his or her job right. If that person is supposed to be invisible. The game is a thing, right? And not the rules. When the rules are paramount and the arbitrary decisions of the referees are paramount, that is not a game. It is I don't know, it was a kabuki theater, whatever it is. It's not the game we came to play. And I think that we're not playing the game of enterprise as we ought because the Fed is too much with us.
So now we've explained to some degree the causes, the backdrop that led to this mess. Let's talk in some detail about what can or should be done to fix it. So yesterday, this podcast will be coming out in a couple of weeks, but yesterday the Labor Department announced that inflation has been rising at a rate of 9.1%. Cost of food was up, I think, 12% in the last 12 months. Electricity up nearly 14%. Gasoline up about 60%. So first of all, I mean, the most obvious question, it sounds so mundane, but I'd actually kind of like to ask it. Why is inflation so fearsome? Why is this thing that we'd kind of forgotten, this looming Loch Ness monster beneath the surface of the financial waters, so terrifying? Why suddenly is everyone sitting up and saying, oh God, there's a real problem here?
Well, Nessie, I think, might not exist. I don't know for sure. But inflation was consigned to the status of Nessie by a generation of economists who, like preceding generations of economists in the 1960s, believed that they had found the philosopher's stone. And they, through their dexterous manipulation of this and that lever of policy, could forestall and ameliorate, as I said, in case of death. Okay, so that was the conceit. To go back to a sporting metaphor, I think that muscle memory played a great part in conditioning everyone to expect everything except inflation. Now, if you simply ask the following question, the answer is going to be, yeah, inflation. And the question is this: what will happen when the government pays people not to work, when indeed it subsidizes the lack of production through various rules and regulations, when it materializes money as it has never materialized those dollar bills before, and as it borrows and spends in the space of 18 months as it has never been before, what is likely to be the outcome? And the schoolboy of yore would say, yeah, inflation. Notice that no one said, of course, inflation. There's a baseball story having a guy say, 1968, Bob Gibson was the reigning pitcher in baseball, imperious, majestic, and domineering figure was Bob Gibson at St. Louis Cardinals. And he played with an infield named Ducky Schofield. Ducky was very good in the field, not much of a batsman. That's a cricketer.
Yeah.
And one day, Ducky strikes out, storms back to the bench, and curses up a blue streak, smashes the water cooler, and Gibson can't stand it. He summons Ducky to the end of the bench and points to his batting average, which was .226. And he says, Ducky, what did you expect? So similarly, today with inflation, what did they expect? Well, what they did not expect was the obvious. We now could piece it together, right, all of us. But the fact that it was not obvious speaks to muscle memory. It speaks to the conceit of the economic forecasting fraternity. And it speaks simply to, I guess, to the foibles of human perception.
This is a really important point just to underline before we move on, because it really gets at this question of just having to be a little bit humble about our own.
Okay, I want to digress with a story. So years ago, there was a bunch of medical scientists got together to examine a cadaver discovered in the melting ice in the Italian Alps. And this thing is called the Iceman, right? So the greatest heart specialists and physiologists, I mean, the anatomists, people with a scientific interest in the human form came to the relevant hospital in Italy to examine this Iceman, right? And they spent weeks going over it with the advanced tools then available to them, X-rays and things that I can't, and it wasn't until the very end that someone said, yeah, there's the arrowhead right there. and the relevance of this is that, the ones who missed it were so embarrassed and so humbled. And we wrote a piece about this, and the headline was Perils of Perception. And our story wound up that if the scientists who missed this were not, they didn't have financial, they weren't leveraged in the market betting on some outcome, right? They didn't have an options position open. They had no financial interest in the outcome. They were studying this and a disinterested academic if they missed it. So we wound up saying, well, so how is it that with people through force of financial interest, client interest, how any of us solve it, given all of the impediments to clear perception in finance? So that's why things periodically get so messed up. That everyone has a different set of perceptions, but the population of people who are paid to have a disinterested perception, it's a very small population, and of course they are human, right?
Yeah. So even the fact that you're trying to be aware of your own bias, your own proclivity to be gloomy and to see problems, to protect people from problems that
my own character traits. Yes, yeah, absolutely.
That seems to me a really profoundly important lesson for any investor. Just to be aware of the fact that if people as smart as all of these PhDs working at the Fed can be as wrong about the unfathomable future and as overconfident about their own brilliance, it should give us pause, especially for someone like me who doesn't have any of that training, to start to think, well, on what possible basis do I think I can predict the future?
But there's an extreme in this direction as well, and the extreme is something called the efficient markets hypothesis, which is a thing. It is held widely in academia, and what it holds is that prices at any given moment in stocks, bonds, whatever, are just where they should be, because information is instantly absorbed and processed through the human brain and through algorithms and bots and the like. So don't try to outguess the market. Just take price. So no, because that fails to recognize the capacity of humans for crowd behavior and for a mass hypnosis under the spell of the Federal Reserve. So it's a lot more interesting than the efficient markets hypothesis, right? So that's what lends the steel and the poetry into this line of work. You must know, but you can't know.
Yeah, and I think
if you follow.
and both of us, I think, come much more from the school of Ben Graham of saying, far from this being efficient, Mr. Market is crazy, and once in a while gets so carried away that that's what creates tremendous opportunities for really smart, dispassionate investors. But
I wrote revised the preface for the next edition of Security Analysis. Seth Klarman and I are involved in this project, and others. And I was reminded while doing this of how little the precepts, the wonderful, true and logically consistent precepts of Ben Graham, how little they yielded to an investor over the past dozen years. Because Benjamin Graham was all about a margin of safety. But when markets are levitating, as they did in the late 90s, for example, or in Japan from the 80s into 1990, a margin of safety is the last thing you need. If you want to keep up with the Joneses, you have to throw all that aside. So it's not a very comfortable period for yes, but guys.
Yeah, I think it depends how seriously you take the question of survival.
Right. Yes, exactly. So, right. And also, how long is your investment horizon? If you're starting out, you're 22 years old, got your first job, you can actually afford to pay no attention to the cyclical fluctuations because you have all the time in the world for things to recover and for compound interest to work its magic. That's fine. But if you are even a little bit older, it pays to. Okay. So I can help I can help with one thing at least on this lovely podcast, and that is a book suggestion, and the author is Fred Schwed Jr. Schwed, Schwed, and the book is "Where Are the Customers' Yachts?" It came out in 1940, and Schwed says at one point, the heading in this chapter is "A Little Wonderful Advice," and he says. Here's how you can have the pleasure of dying rich. He says, what you want to do is when everyone is selling stocks, you buy. Now, you won't get the bottom, and they'll go lower. Pay no attention. And then wait, and they'll go up a lot. When they go up enough, just sell. They'll go up more, but again, pay no attention and repeat. And you will have the pleasure of dying rich. And this is a charming story. And there's a lot of very helpful human truths in this book, but that is about the least possible thing to do for the average human being, because we're all carried away by gloom at the bottom and by euphoria at the top. We're just perversely wired. It's just the devil himself wired us for finance.
Yeah, absolutely. Well, I shared some comment of yours on Twitter the other day, which I know I could rip off from you because I know that you're not on Twitter very much, where you talked about, I'll get this wrong, but it was something about how at the top of the market, we're all convinced that 2 + 2 = 5. And at the bottom, we're all convinced that 2 + 2 = 3. And this just seems like a really recurring trait.
At 3 at most.
At most, that's right. That's right. You're remembering your quote better than I did. To get back to the current issue that we're facing,
yes, okay.
This burst of inflation. What are the Fed's options for actually dealing with inflation? And you've talked about the risks of accidental outcomes that it faces. Yeah. So can you talk about the high risk of a financial accident that could be created by the Fed, which, as you've pointed out, is not entirely omnipotent and omniscient?
Yeah. Well, one of the great Austrian thinkers of yesteryear, Ludwig von Mises, sounds like he'll be conducting the Vienna Philharmonic. But von Mises was a great economist and lawyer, and he said the trouble with what the Fed does to rid us of inflation. So first of all, it overdoes it, thereby causes inflation. So it's like a driver who runs over you with a car. And then to fix the problem, the driver backs up and runs over you in reverse. So what the Fed does is, in the language of economics, is to pursue a course of demand destruction. Proverbially and trivially, inflation is too much money chasing too few goods, too much demand in relation to supply. So demand destruction is the thing, right? So you want people to spend less, to want less, or to want it, but they have to give them less money to do it. How do you do that? Well, you wreck the economy. So you raise the rate of interest. And so the question before the House is whether the Fed artfully can raise its rate just enough to destroy just a little bit of demand at the margin, but not so much as to sink us as a society into a slump. Now, I think the way to imagine this is to put ourselves in mind of the old college freshman fraternity initiation trick, and that is yanking a tablecloth out from under a set table of china, glassware, and porcelain. Now, if you go on WikiHow to investigate how to do this, WikiHow will advise always try it with plastic cutlery and cups. But notice the Fed has not got that option, because the table is set proverbially and metaphorically. It's set with the most brittle glassware and the most precious porcelain and bull market champagne flutes, because of the 12 years of suppressed interest rates, which have fostered risk-taking, which have brought forth into the world all these companies, because some of them are called unicorns because they come to market worth $1 billion and generate not much earnings. So the world is full of uneconomic economic projects fostered through financial stimulus. It's principally low interest rates, right? So what happens when you raise the rate of interest on companies that need to borrow to stay alive? Well, they can't stay alive. So they're cascading failures, and companies supply those uneconomic things. Now, think of the craft beer makers that sold beer to WeWork in the day, right? So there's a whole chain of economic activity that goes to support uneconomic activity. So that's the metaphor for the Yankee the tablecloth. It's not plastic cups on the table. This is glassware. And the glassware has been made all the more brittle through the Fed's earlier stimulus.
So we're sort of flying blind here.
Yes.
Is your bet that the US economy can escape a recession, or is your bet that it's going to get pretty ugly?
William, here we come face to face with personality and character and vested interest, right? So what would be better for grants than calling another disaster? I can imagine the motion pictures. I can imagine a parade is probably true, but I can imagine our circulation going up a lot.
The Big Short Part 2.
Right. So here's what. So without obsessing on interior dialogue and motivation, what I try to do is to reserve mind space for the not impossible outcome that things work out. The United States economy is something that has demonstrated the greatest resiliency over the years. I mean, I think one hears rather too much about Americans, not singularity, but exceptionalism. Right? So America is exceptional in many ways. Certainly, its economic history is exceptional. So there's a can-do spirit here. There's a spirit of enterprise that not even the Fed can extinguish through its maladroit policy maneuvers, or President Biden extinguished through his lectures from the pulpit. So yeah, it's possible that through luck and maybe the Fed's learned something. But I think that, so the question then becomes, where do the risks lie and where do the opportunities lie? Given that the outcome is indeterminate, are you being paid well to think one thing that is possible, indeed probable? Are there bargains, in other words? Are there bargains that people are neglecting because the world is so single-mindedly focused on some? And I don't see many just yet. We have a very good equity analyst here who does other things well, but his name's Evan Lorenz. He's the deputy editor of Rants, and he does fabulous work in analyzing individual stocks. So we had been very bearish on Facebook. But and the current issue came out, and Evans did this fine work, and he says that Facebook is now a buy. It's cheap on its merits, on its earning power. It has been unduly punished for its foibles and its managerial errors. And now we ought to pay attention, because it is now a value-laden stock. There's a margin of safety. So there are these opportunities cropping up. The risk is, and I see this a lot in people who manage what's called value portfolios, is that the cheap stocks do go down with the ones that are too expensive. I know of value investors who have suffered losses this year on the order of 20% or more, although they thought the stocks they owned were so cheap that they were inured to such things. But no. So it's been a brutal year for many people. But in answer to your question, what we try to do is keep scouting for opportunities. We don't see it in the bond market. Although if there's a recession, bonds will go up in price and down, and interest rates will fall likely. We see opportunity in gold stocks, which are almost universally ignored and scorned. They're about as cheap as they've ever been in relation to the metal. But if the Fed is seen not to have the great answer, if the Fed is seen to be an institution you must protect yourself against rather than to trust in that case, this is something I've been expecting for as long as I've been alive almost. In that case, gold can do very well.
Let's unpack some of this in a bit more detail so that we can give our listeners a kind of practical sense of what most likely they should avoid and where they should kind of look for opportunity. So you've talked a lot about historic bear market cycles for bonds and the impact that interest rates have in terms of these really long cycles. And as I understand it, the moral of reading what you've been writing about this recently is we just had basically a 40-year bull market driven by ultra low interest rates that are now reversing. And I'm trying to get a sense of whether what you're saying is we're done, just stay away from bonds, basically. That for example, I remember Jack Bogle once telling me, you could just make a single decision of having a balanced fund that had 60, 70% stocks, 80% stocks, or whatever, depending on your age, and then 20, 30, 40% bonds. And there are people now saying, well, actually the 60-40 portfolio is done. You're toast with that. Can you talk about what this knowledge of the history of these huge bond market cycles tells us about whether we should just avoid bonds totally now?
Yeah, a bond is a promise to pay money. And the best thing that happens to you with a bond is you get your money back with interest. That's the upside. And Ben Graham, writing about bonds, reminded his readers that a bond is not going to triple because management is chanced on some wonderful invention. As the upside is limited, so are the risks great. So bond selection is one of exclusion rather than of selection. You approach it with the idea of avoiding risk. So what about Treasury securities? They're characterized as super safe in the Wall Street Journal. They have anchored most retirement portfolios for most of the past 4 decades. One way of looking at it is to observe that over the course of 150 years of financial history, bonds have tended to move over the course of decade-long cycles. Interest rates would rise for 30, 40 years and fall for 20, 30, 40 years, and so on, starting from the late 19th century to the present. They have fallen for 40 years since 1981. Now, it might be that cycle has broken. I have been a little too eager to declare the end of that cycle. And in my newly found humility on that point, I will not now say, at least not out loud, I might think it, that the bond market still might revert to going down most of the time. But if indeed the cycle has ended and rates are going to go up, we are in a different investment world because bonds will not provide the hedge that they have against falling stock prices. Just recollect that for everyone's investment memory, really, when stocks got into a rough patch, you had some protection from falling interest rates and rising bond prices. But if bond prices are falling and interest rates are rising, you are forever not getting a hedge, but rather a drag. And so the 60-40 or the 70-30 portfolio is not the thing for you. Now, this is still speculative, but I think that it's likely to be the case. And people ought to be alert to the idea that something new is in the offing. And what that something might be is kind of in the womb of time, but we can guess a little bit about it. It might be that, I don't know, it might be that stocks are going to become more important after they reach a point at which they become truly cheap. It might be that cash, for all of the damage that inflation does to cash, might be the cash is going to be the thing rather than longer dated bonds. So one would have a 60-40 or a 70-30 portfolio, but the 30 or the 40% portion would be in a near cash thing, maybe a 1-year treasury bill, for example, or a short dated municipal bond fund, rather than 20 or 30-year securities that yield you more. You sacrifice some yield for the protection against capital loss that is part and parcel of the longer dated security.
So we had several questions over Twitter about where to find safe havens, where to hide, particularly if there's a fair chance that they're likely to be lousy for a significant period. And I remember there was a lovely line from you, I think, in Grant's Interest Rate Observer, where you were talking about, I'm getting the hang of saying Grant's now, where you said, investors feel compelled to own bonds not as income-producing vehicles, but islands of safety. And you were talking about the delusion that they're intrinsically safe. And you were pointing out that they were dubbed certificates of confiscation back in 1981 and were deemed intrinsically unsafe. So if we accept the hypothesis that although we don't know the future of the bond market, at least we now know they're not intrinsically safe. There are periods in which bonds can be a terrible investment. So this raises the question, where should we hide? And so there were several questions about gold. Someone who has a terrific name, he's called Doherty Twit on Twitter. This a gentleman named Bob Doherty said, Grant has said that gold is not a hedge against monetary disorder. It's an investment in monetary disorder, which is what we have. And he says, how would Jim make the argument that gold could be part of the solution? And then someone called Dr. Hugh Axton, who describes himself very nicely as a former hedge fund manager striving to see the world as clearly as possible, says, why hasn't gold performed better in this environment with rampant inflation and negative real interest rates? So could you talk a little bit about whether gold should be a place we should hide?
First of all, it is true that gold has disappointed its many fans. Actually, not some, but those fans it has disappointed. It has not twigged on to the fact that the competition it faces from interest rates is a very meager competition because, after all, with a 9% inflation rate, you're still losing massively on a bond that yields 3 or 4%. The rate of inflation is taking most of your money. And because the coupon, or the rate of interest it pays, is so low, there's no protection against the loss in price. Back in the early 80s, a bond would down 15% in a year. And that's fine because the coupon was 15%. You could absorb the loss. So the interest competition against gold, a non-interest paying asset, is slight to meager. Yet, gold has retreated in the face of just the Fed's promise to raise interest rates. So the gold market betrays a most unbecoming trust in the institution that we are meant to be hedging against. So that part of it is fabulously annoying to me. It's as if Mr. Market does not read what I take the trouble to write every 2 weeks. So I can't explain it. I can deplore it, but I really can't explain it. Maybe it's, I can recite reasons why gold hasn't done well, and I will. For example, the dollar is the world's the great reserve currency. It is Hercules itself in relation to the euro, which has as its money master or mistress, Christine Lagarde, who has to this date kept the policy interest rate of the European Central Bank at 0.5% below zero. That's in the face of a raging inflation in the continent of Europe. And when you look at Japan, another major currency the dollar competes against, the Bank of Japan has chosen to suppress its bond yields at just about zero and let the yen exchange rate go to just about zero, seemingly. I mean, the exchange market is eviscerating the dollar-yen exchange rate. Okay, so
you're saying it's basically it's three gangs that can't shoot straight, sort of firing.
But one at least possesses a weapon.
Yeah.
Yeah, so that's one reason, and I think also gold is up against its very tangibility. One of the oddities of 2021, apart from levitation of Bitcoin, was the millennial obsession. It was a very brief live thing, but tungsten cubes. Did you hear about this? Tungsten cubes.
I loaded up on them, Jim.
Became a thing. And I was thinking to myself, if you want to buy a monetary metal, why don't you try one that is actually money? But
yeah, weren't these just they were pictures of tungsten or something? I don't know. I feel like 140 years old when I read.
Granted, it's very heavy. It has certain metallurgical properties. But anyway, so I think that the world is, for whatever reason, has turned its back on gold. So the question before the House is, that's the past. That is indeed the present. Is the future shine any brighter? And my case for gold is that it is the monetary asset that is not in the world of credit. Credit is the promise to pay money, right? It's the bond market. It's the loan market. So we live in a world, a financially honeycombed world of promises, financial promises, debts. And the ratio of these debts to income worldwide is an all-time high, especially so in China. And I think that before long, how long, oh Lord, I don't know, before long, the world will see in gold an island of safety from the world of credit. It's a monetary asset without a counterparty. No one owes you anything on gold. It is itself. It's itself. It's value in itself. And the trouble is people don't see the value yet, but I think they will. Now, gold stocks are even worse than gold. Never have they been, I think, I'm saying this, never have they been cheaper in relation to the price of the metal, because people don't believe the central banks can really come a cropper. Now, I've seen, so old am I have seen central banks become completely marginalized and discredited in the 1970s under Arthur Burns and G. William Miller, and indeed before them under William McChesney Martin. Paul Volcker himself was discredited as an assistant secretary of the Treasury before he became the deity of modern central banking. So my bet on gold is that it is indeed an investment in monetary disorder, which to date is still latent and not manifest. This could be a web of rationalization that is going to get nobody anything except trouble. That's the way I think.
And in practical terms, I remember reading the part of your own investment portfolio that you manage is the part that's in gold. Can you give us a sense of what would be a sensible way to invest in gold for people?
Sure. So what were your threshold question? If you your two threshold questions, one is, do you want to own the metal itself or the mining shares? And the second one, if the metal itself, do you want to own the exchange traded fund, which is the metal but in paper form, or the things that you can possess? And so I've chosen to own Krugerrands 1 ounce coins, and they're available from
from under Jim's bed.
Those aren't for sale, though.
I'll be publishing Jim's address in the show notes, so you can go visit his Krugerrand stash.
What do they call that when the Supreme Court judge gets anyway?
Yeah. So really, that's a better bet to own.
Well, it seems to me that if you want protection against bad things happening in the world of finance, especially the world of credit, then you want a tangible protection and not something that itself is part of the problem or could be part of the problem. So you want the physical thing. Okay. So but mining shares offer a value proposition. They're deeply discounted, widely, not so much unliked as ignored. So there's, I own something, for example, called the Sprott Gold Mining Trust. I guess anyway, John Hathaway is the guy used to be called the Tocqueville Gold Fund, but now it's called Sprott, SPROTT.
And he's smart. He's someone you would.
Yeah, he's a very good gold stock manager. So that's one. So that's gold. I said, so this, my reasoning for it. Some of the ways to look at playing. There are all sorts of alternatives to John's fund, all sorts of alternatives to owning individual Krugerrands. Those are some ways to approach it.
So, Jim, you mentioned tungsten NFTs, which I'm guessing you weren't loading up on, but there are a lot of people out there who, in terms of cryptocurrencies, have been saying that Bitcoin is a valid and worthy hedge against financial chaos and against the kind of reckless monetary policies that you've been seeing. And I'm guessing that you just see the crypto boom as a kind of outbreak of irrational exuberance and the madness of crowds. But Could you talk a little bit about your perspective on Bitcoin as probably the most, I hesitate to annoy loads of people, the most defensible of the cryptocurrencies? Do you give it any credence as a hedge against reckless monetary policies, or
Nope.
Why?
So, first of all, let me give props to the people who did see this for the thing, capital T, it has become. I remind myself of Lloyd Blankfein, the chairman of Goldman Sachs in the day. And Lloyd Blankfein was asked about gold in, say, 2011, when it was like $1,900 an ounce. And he said, "What do I know?" He said, "I was bearish at $35 an ounce." And similarly with Bitcoin. So having given proper props to those who saw it for what it was then. So what is it? Is it money? No, it's not money. Is it something you can transact with? Well, it's awfully clunky for that. Is it a store of value? Well, I don't know. Drawdowns like 80%. I mean, has anyone ever taken out a mortgage in Bitcoin? Would Elon Musk, when he was besotted by Bitcoin, would he have written a Tesla warranty in Bitcoin? One day it's worth $4,000. The next day it's worth $40,000 to the buyer. To him, it's a cost $4,000. No, he hasn't done that. Nor has anyone taken out a mortgage in Bitcoin. I think maybe someone has. So I think that. And so if you're really a zealot on Bitcoin, what you're saying is the world of technological innovation will never create something better. So it's crazy. I mean, Bitcoin trades like a tech stock. It is as vulnerable to disruption as any other tech stock. I mean, who's to say it's not the Palm Pilot of cryptocurrencies? I used to work with a software program, a word processing program called Multimate. Oh, I love Multimate. Never mind that I actually lost a book chapter once on Multimate. It just vaporized, but still I loved it. Many of these people cling to Bitcoin. Went down from 68,000 to 19,000. I said, I still love it. But I think that Bitcoin is vulnerable to that. Also, Bitcoin used to be the thing you say if you wanted to buy a container full of surface-to-air missiles. You go to Bitcoin, you go to the dark web and you use Bitcoin, right? It's perfect for it. But now Bitcoin wants to become respectable. You're like you, William, you're like me. So Bitcoin is now being regulated. Now it's this leverage. The snake in the Garden of Eden. Credit has now entered the world of cryptocurrencies. I know this because of the serial bankruptcies of hedge funds and lending platforms. So the thing that the inventor of Bitcoin wanted to get away from was central bank centrality and credit risk, right? Nope, hasn't escaped it. There's all sorts of ways that this is not decentralized, all sorts of ways in which it is vulnerable to the vicissitudes of the world of credit. And believe me, there ain't nothing more given to vicissitudes than the world of borrowing and lending.
Are there other places that you're seeing a lot of opportunity at the moment in terms of Japanese stocks, which I remember reading recently in Grant? He was saying they're underfollowed and conservatively capitalized.
I think there are a lot of good things happening in Japan at the company level. I think the guy who's running monetary policy his obsessive focus on raising the rate of interest is doing enormous damage to the Japanese credit market. But however, at the company level, many good things are happening in the simple business of making a profit. And that's not being widely recognized. There are financial institutions worldwide, but perhaps especially in Europe, that are being tarred with the Ukrainian war, Russian-Ukrainian war, and that are selling at really fetching multiples. I don't want to name them because I own a lot of them. I'll tell you about it, that something that people might take a shine to. There's a tiny mutual fund that is interested only in owning value-laden stocks. It's called the Palm Valley Capital Fund. People who founded it were very good investors, but who would not participate in the levitation, in the everything bubble. And they went off on their own. And they said, all right, here's what we're going to do. We're going to wait until we see stocks that are absolutely cheap. Then we'll buy them. But we're not going to keep up with the Joneses. And I found what they did. What I dare say they have our grand story up on their website. I bet they'd be foolish not to. I think the world of the two of them, and Eric Cinnamon is one of them, and Jamie Wiggins. But I think the world of them, their discipline, their adherence to the doctrines of margin of safety. So they are going to be around whatever happens. And the stocks they own will do very, very well after the dust settles. And the dust will, there will be dust. There will be dust.
Well, what about China, Jim? I read a lovely line from Grant's a while back where you talked about the West's financial love interest being China, despite, as you put it, such so-called warts as autocracy, tyranny, the official persecution of minority peoples, the subjugation of formerly free Hong Kong, threats against Taiwan, and the creepy omnipresence of the Chinese Communist Party. And I was wondering whether since prices have fallen in a lot of tech stocks, among other things in China, whether you've become more enamored or whether that language suggests that you're still a China skeptic.
I'm a seller at zero. No, China is the worst. And China is getting its comeuppance there as we speak. There is a spreading nationwide strike against paying one's mortgage interest owing to the failed promises of sundry real estate developers. China is the most leveraged, most corrupted marketplace, not just corrupted. Well, let me put it this way. If you ever see a currency with on one side, there's a picture of a mass killer, you don't want to own that country. So this is a country with Mao on the currency. What are they? They're telling you something. Just don't do it. It's like Bob Gibson. What do you expect? You lost all your money in China? Yeah. What were you expecting? God, I can't stand that place.
I'm glad I asked. So in terms of your own investments, over the years, you've known so many remarkable investors. I know that Paul Isaacs, who I interviewed for my book, but I didn't write about, who's brilliant, is an old and close friend of yours. Seth Klarman, obviously, you've been close to for many years and has written for Grant's Interest Rate Observer. Jim Chanos, the famous short seller, has been a great source and friend. And I think your daughter went to work for him as an analyst at some point. And so I'm wondering over the years, given that you're sort of the insider's insider, whether you ended up investing with some of these remarkable people yourself.
Yes, my family has for us a fair amount of money with Paul Isaac, who has been having a very rough time. He's been buying the aforementioned financial stocks. Some of them in Europe are selling at less than 2 times earnings. I mean, everyone is afraid that. They're afraid of the gas getting turned off. They're afraid of the inflation that is spreading, and that the European Central Bank seems to be very comfortable with. So, his view, my view, is that these things will pass. The underlying idea is that value comes out in the end. It is a trial while waiting for that to happen. But we wait.
Do you have any advice for our listeners on how to handle those emotional challenges during those long periods where you're trying to be rational, but you're kind of barraged with emotion? I opened up a couple of statements yesterday for hedge funds that I've invested in, and one of them I think is down 40% for the year, and I look at it and I'm like, wow, and I'm kind of fine because I don't have any serious debt or anything like that, and I knew that it would be volatile and it was giving up some of the great returns, but it's still
well, William, I tell you what, are you one of these people that gets tested every week for COVID?
No, I just sit around in my study and read.
Right. Well, see, you can open the envelope and look. You don't have to.
Yeah.
So one approach is to pay less attention. Now that is exactly sticking one's head in the sand. That is literally sticking one's head in the sand. Now that is an appropriate, I think, stratagem. You're 23, I'm gathering, looking at your picture.
Yeah, just based on my physique and my handsomeness and my beautiful skin. Yeah, you've got it, Jim.
As one ages, one must pay closer attention and watch for drawdowns, as we clinically call losing money. I think one ought never to be fully invested. Always ought to be a lump of cash for the sake of opportunism, for the sake of what you can't see but can't even imagine, but will come your way. The opportunities come in all sorts of guises. And one of the age-old guises of opportunity is disaster. So how to cope? I think this is where financial history comes in. Just knowing that this too shall pass, but knowing also that if you don't watch out, a lot of things do go to zero and stay there. You have to. You can't. I'm afraid some of this is coming across as most unhelpful. People who have really gotten stuck cannot get unstuck by following the wise words of Bernard Baruch to himself in the year 1930. Become humbler as the market goes your way. Thank you a lot. Thank you a lot. That's not now. Please tell me that later. So I'm not exactly sure how to answer the question. I think it's like if you come down with cancer. By the way, you ever spoke? Yeah, it's just, well, don't have done that, right?
Yeah. Let's talk more about Bernard Baruch, because I've spent a very pleasurable portion of the last week reading this really lovely book of yours, which I'm holding up for those who are watching on video, and I'll put in the show notes, which is called Bernard Baruch: The Adventures of a Wall Street Legend. And as you were mentioning, he wrote this memo to himself in, I think, 1930.
Yeah, he wrote to himself, right?
And it's an amazing thing. I mean, can you first introduce us a little bit to who Bernard Baruch was? Yeah. And then let's talk a bit about what the lessons are that he figured out along the way, because he was one of the world's great investors and speculators who's largely been forgotten. But I think the lessons from him are actually really profound, particularly for those of us who've been going through difficult times lately.
His dates were 1870 to 1965. He was born in the post-Civil War South to a former Confederate surgeon. Grew up in very, very straitened circumstances. He moved to New York. His family was very close. He was well educated at New York City public schools, went to Wall Street. And by the time he was 30, he was a millionaire. Now, that was when a millionaire was something.
Yeah. And he did it in about 3 years, right? It was something like 1897 to 1900. Yeah. He went from nothing to $1 million.
Yeah. Some of these details are a little bit foggy. I wrote this about 4 years ago. But Baruch began as a trader in public securities. But he made his big money later on in what we would now call private equity. He became a principal, a rather reluctant principal, in something called the Texas Gulf Sulfur Company. So he, at the top, you might have a better recollection of this than I do. I have a footnote. I remember this footnote. At the top in 1929, he was worth, $30 million or something?
Yeah.
40. So he was an old-fashioned millionaire. Gold was $20.67 an ounce, and he was worth 30 million, let us call it, of that kind of dollar. He was a fabulously wealthy guy for his age. So he was a political figure. He was a speculator, and then he became respectable, and then a banker. But he was doing the same thing all the time. He had a saying. He said, "The speculator is someone who looks out into the future. Okay, you want to know the future, but you can't. But you can judge likelihoods." All right. So he goes into the crash, owning a lot of securities. And contrary to the myths surrounding his reputation, he was not in cash, having expected the crash. He was rather a new era bull who did not expect it, who was perfectly willing to admit that things looked toppy or overdone. But I think that the greatest chapter in his investing history was the recovery from that attitude towards one in 1930 that was very suspicious of what was then a very meaningful recovery in the stock market. It's the spring of 1930, the market came back. A lot of people, it's over. But Baruch was not so sure. He was very defensive. And it was at that time he wrote this memo to himself. It was, forgive me, I've forgotten some, but it was like a personal equipment.
Yeah,
And,
I mean, I have it here, Jim, and I mean, as I said to you before we talked, I said those 2 pages are worth the price of entry for the entire book. They're pretty amazing. And there's one thing. I mean, it's personal equipment, and it's all his advice to himself. So, for example, he says, he's talking about prudence, and he says, "Be pliable, or you won't be prudent." And he puts this in italics, as the quote you mentioned before. "Become more humble as the market goes your way," and then he talks about pliability, and he says, "Consider and reconsider the facts and your opinions. Stubbornness as to opinions, cockiness must be entirely eliminated." And then he says, later on, he talks about the unforeseen, and he says, "Always make allowances for chance, or chance, as you would say. Keep a financial and mental and physical reserve."
yes.
And there's something about the humility of it, about the sense of someone who's just had the beaten out of him, and he's looking at himself and he's saying, what have I learned? What does this tell you about the need for humility, the need for prudence, the need to avoid cockiness? And yet he goes back in and then basically ends up with 25 million or so in his personal fortune, which, as you say, was real money back then.
Yeah. Well, it's quite an inspiring story, I think. One word on this, a word on the word stubborn. It's kind of a cliche on Wall Street that you are stubborn if wrong, but you exhibit conviction and character if you are proven right. So Seth Klarman and Paul Isaac alike are examples of value investors who are quite comfortable in the skin of their own analysis. In other words, I see a company, and the company is earning $4 a share. It's priced at $40. So it's 10 times those earnings. Price is 10 times the earnings. And then the Fed clears its throat and says it might tighten. The stock price is now 36. Well, it's not as good as 40, but they're still earning $4 a share. And now the Fed says something else, or the economy hits a little rough patch, and the price is now suffering not 36, but 28. And so it goes. And now it's earning $3.50 and not $4. But the ratio of price is much cheaper. Is it stubborn to hold in the face of what could be a very devastating bear market? Or are you exhibiting the clarity of perception and the analytical conviction of a properly informed long-term investor by holding and buying more as the price comes down? So this is the eternal tension, right? It's the eternal question. That's why some people succeed on Wall Street and some don't. It's not as if anyone can do this. Not even the professionals can sometimes do this. It's so hard. The analysis is hard, but that's nothing compared to controlling one's own perceptions and emotions. Jack Bogle and I count him a friend, not just a Wall Street acquaintance. And he was kind enough to speak several times at we have a conference once a year now. Jack spoke once, and this was around 2000, and I think it was, if memory serves, which it so infrequently does. It was 2009, 2010, the crash, the crisis was fresh in memory. And Jack confessed that, he felt just the way everybody else did. The world was ending. Yeah, it was ending. So, but it doesn't end, does it? One, right. So they say. But I don't know. I'd like to see them go down. I'd like to see them for sale at the bottom. I love that. I'd love to collect values and bargains. So that's my rooting interest.
Yeah, and there were a couple of important lessons that I drew from your discussion of Baruch, where you said at one point you wrote, "The best speculators seem to buy when everybody else wants to sell," and so he did have this ability to buy cheap. But then at the same time, you said Baruch's speculative genius was his trader's flexibility. So you talk actually about the opposite characteristic, which is saying the successful
I know.
stock
Well,
trader.
it's a battle of cliches, isn't it? One of the great bon mots of yesteryear's turn of the 20th century in Wall Street was so-and-so, some great speculator, was all nerve and no nerve. That's kind of descriptive of a certain kind of personality. Now, Steve Cohen, for example, the hedge fund guy who owns the Mets, I see that as kind of an all nerve and no nerve.
In what sense?
Unflappable in the face of adversity. Nerve, in this case, refers to flightiness or jumpiness. And you could be all nerve in the sense of having, again, a kind of a tactile sense that something's wrong. And just for no evident reason, change your mind. That's all nerve. And no nerve in the sense of being impervious to the crowd, of standing aloof from the crowd and its emotions and its stampede. That's no nerve.
I remember you writing at one point about the importance of intellectual flexibility. And it seems like that's one of the things that you admire most in the best investors, this ability to be open to what you've called seemingly heretical ideas.
Yeah. Well, that's the people who, some of the people who made money in Bitcoin were those who had no conviction at all about its utility. It was, you hear these evangelists now, some of whom had public companies who say that the world will never be the same. Bitcoin it changes everything, and the people who perhaps make more money and say, "Yeah, it's a trade."
Bill Miller came on the podcast recently, and I've been interviewing Bill basically for 22 years, pretty consistently. And Bill is just one of the great sort of agnostics in life, and he just said. He was talking about Buffett and Munger saying that Bitcoin's a non-productive asset like gold. And Bill's like, since when was investing about owning productive assets? He's like,
well, I think
making money.
Yeah, well, all right.
I thought it was interesting, though.
That's Bill. I say that with half respect and half all respect, but a little bit of exasperation. I think that's too cynical. Yeah, no, investing is not about lights on the Bloomberg screen. Investing is about the allocation of capital. It's cosmic sense, or it's macro sense. Investing is about the proper allocation of funds into productive enterprise that society needs to grow and prosper. All right, so when the central banks are directing investments and manipulation of the most important price in capital, maybe interest rates, that money gets misdirected. And Bill Miller is fine in buying these. Maybe did Bill Miller ever get long electric truck manufacturers? I might have. There were lights that were probably lighting and flickering at him. He got long Bitcoin. It was a flickering light. I think it's more than that. I think that's way too cynical.
Interesting. I guess what struck me is just there are different ways to climb the mountain, and it's
yes. Oh, yes. There are all sorts of different ways to make money. But I'm saying that to completely separate earning power and financial stability from money making, I think it leads you into the newest fad, the hottest manager, the most speculative names, and the deepest remorse.
But I think one thing I like about Bill that I think is very similar to you actually is that kind of philosophical open-mindedness, that ability to say, well, what is this thing? And I don't think I've ever met an investor who's more open-minded. You look unconvinced. For those who are listening to the podcast, let it be recorded. There's a pregnant silence.
I don't understand Bill's approach. I do understand and comprehend and admire his success.
Yeah. So, Jim, one of the things as we begin to draw this to a close, since I don't want to try patience excessively.
It's too late for that.
Sorry about that. We're about an hour beyond that point. In your preface to the Bernard Baruch book, you mention in passing that the most precious commodity is time. And I wondered now, as you mentioned to me before the start, you're approaching your 76th birthday. When you look back and you think about how you spent your time doing, many books, much journalism, all of this stuff, what gives you most satisfaction? What do you think you got right in life about getting the balance between your work, your family, your 4 kids, all of this stuff?
What I got right in life is the former Patricia Kavanaugh. So as to time and its uses, I looking back on it, I mentioned at the beginning, I spent hours practicing Mozart, and Richard Strauss on the horn, and playing arpeggios and scales and etudes, and that was in isolation in a room, practice room. And then my life has been typing in a room, and I guess I have chosen that because that's who I am and what I wanted to do. But looking back on it, I don't say I wish I'd gotten out more. I love what I have done. Now, next time through, assuming we all get another shot, right? I want to be the kind of guy who not only enjoys having written, but the guy who enjoys writing. That's going to save me an awful lot of aggravation.
Oh, I'm so glad to hear that, Jim, because when I read your writing, and I'm not trying to butt you up, you're a really wonderful writer. And several times this week, I would be on a call to my mother in London, for example, and I would read her something that you wrote. And the other day I had John Gertner, who's a wonderful writer, over, and I read him something you'd written. And I'm just like, this guy just can really write. And so when I read your,
thank you.
No, you're a really wonderful writer. And when I read your stuff, there's a sense of kind of exuberance and humor and joyfulness and panache. And I was thinking, God, does this guy enjoy writing? Because for me, it's such torture. And so I was kind of wondering whether you reach that stage where it seems casual and easy because you've just written so much, you've done so many drafts, or whether actually there is a kind of delight for you in playing with the language.
I love the language, and your language, I must say. And I am currently working on a book about Edmund Burke and Charles James Fox, and I am immersed in 18th century oratory, and it charms me no end. I think I've probably some shrink would say I take refuge in the past, but I love John Adams, one of my biographical subjects, for the reason of his rhetoric. So I love the language. I hate my first drafts. Second drafts are scarcely more presentable. I keep going until they appear spontaneous. So in a certain sense, it's kind of Potemkin village. But every accomplishment, every well-accomplished thing appears effortless, right? A double play in baseball, or an aria in the opera sung by somebody who devoted his or her lifetime in the practice room. All this appears effortless. So if it appears effortless, that's good. That means that the sweat has been worth it. But I assure you, there ain't no effortlessness in it.
That's heartening, because I mean, there's a part of me, I spent 5 years working on my book, and I saw that you spent 4 years working on your great Bernard Baruch book. And there's a part of me that's like, God, how soon can I climb that mountain again? It's really painful. And so hearing that it's been a struggle for you is kind of heartening.
Oh man, you're kidding. It's I do this also. It's part-time for me. My life's work is Grant's interest rate observer. And that's the most important thing I do professionally. But a close second, the books I'm working on, I spend nights, weekends, and the 4th of July on Edmund Burke and Charles James Fox. So it is at the age of, let us call it 76, I find that it becomes rather a lot. However, the simple joy of my avocation is enough to carry me through such pleasure out of reading what these greats have written, and seeing these societies at work, and trying to decode them. It's a privilege to have the time to do that. Time, just as you say, or just quoting me. And time is I think Samuel Johnson say reputation is the one thing that no man can give to himself. And I would say that time is something else that is not for sale. You can't buy a reputation, nor can you buy the heartbeats. So as life goes on, you become to covet those heartbeats and husband them and expend them in ways that rather more carefully than you were a young fellow throwing them around as if they were confetti. They're not.
And is there when you look back on everything, on all the books, on all the 40 years worth of issues of Grant's Interest Rate Observer, is there some common denominator, some theme where you look back and you're like, that's kind of what I hope my legacy is? Like maybe is there something?
Well, I will say this: we have been right and we have been wrong, but we have always been literate, and I think I should apologize for ever reverting to baseball analogies. I do love the sport. One of the players of the Mets, Keith Hernandez, recently had the honor of his number being retired. I'm not sure if they have this in English football or cricket, but nobody will ever be whatever Keith's number was. Keith Hernandez's number was 17, maybe, or I don't know. In tribute to him, one of the sports writers said that he never threw away an at-bat. He never just went through the motions. And I can say that every single line in Grant's was the best I could write at the time. Some of them, I look back on it, some of them are stilted, I think. Some of them are not. I always want to rearrange something. But nothing was ever tossed up on the wall hoping it would stick.
That's good. That's a lovely and, for me, inspiring note on which to end as a fellow struggler on the writing mountain, to use a. Don't
you despair, William. When the 16th draft is going to come out just the way you want it.
All right, Jim. Thank you so much. This has been an absolute delight, and I
hope the microphone's wrong because I couldn't do this again.
I hope so, and I really admire your work greatly, and all of the wisdom and you've shared over the years. And whether right or wrong, it's always been a delight to read and also to listen to you. So this has just been a total treat for me.
Thank you. Okay.
All right. Thank you so much.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.